3.2 billion yuan landed in China's quantum computing budget in the first 3 months of 2026. That single quarter already reads higher than the country's total quantum investment across all of 2025, and the 15th five-year plan, ratified at the start of this year, has now designated quantum an industrial imperative, the first time that exact phrase has appeared in a national planning document. This script measures the gap between the 2025 full-year baseline and the Q1 2026 reading, traces the mechanisms that bent the curve that hard, and reports what the size of that gap actually proves beyond the numbers themselves. The metric being tracked is China's rolling quantum computing investment, denominated in yuan, measured against a 12-month prior baseline. It is a load-bearing gauge because it captures not just how much capital a government is deploying, but at what speed. And speed of disbursement in a state-directed system is a policy instrument, not a budget accident. The 2025 figure is the baseline, a full 12 months of government and state-directed quantum investment, the prior annual total, whatever its exact value. That number closed on December 31, 2025. 3 months later, on March 31, 2026, the Q1 reading had already surpassed it. 1 quarter, a whole year, 3 months bigger than 12. The mechanism behind that reading starts with the 15th five-year plan. In prior planning cycles, quantum technology appeared under the heading of Frontier Technology Areas, a designation that attracts competitive research grants dispersed across universities, state laboratories, and research institutes on a discretionary basis. Frontier designation means the funding is real, but it is metered, spread across institutions that apply and compete, dispersed in tranches tied to demonstrated milestones, reviewed quarterly. The curve that model produces is smooth. It rises year over year, but it rises in a line. Industrial imperative is a different tier in the plan architecture. The designation does not fund research. It authorizes consolidated capital deployment through state-owned investment vehicles that have already been pre-authorized at the plan level. The money does not wait for a quarterly review because the review happened upstream, inside the document itself, before the first disbursement was ever made. Ordinary research funding works like a drip line, steady and metered, calibrated to what the last reporting period proved. Imperative tier plan funding works like opening a valve that was already pressurized, the authorization built up inside the plan document over months of ratification, and Q1 2026 is simply when the pipe was opened. The drip model produces a smooth annual curve. The valve model produces a first quarter reading that looks from outside like the entire year arrived at once. In a structural sense, it already had. The full year commitment was made the moment the plan was ratified. Q1 is just when the ledger started recording the outflows. That shift from frontier to imperative is a delta of its own, running beneath the headline figure. Under the 14th five-year plan, which covered 2021 through 2025, quantum sat in the frontier tier. Aspirational language, unfunded at the mandatory level, competitive in its disbursement structure. Under the 15th five-year plan covering 2026 through 2030, the designation changed. The number changed as a consequence, not as a coincidence. When a government moves a technology from a category that asks agencies to consider it to a category that instructs them to deploy capital toward it, the funding instrument changes before a single lab has run a new experiment. The Q1 reading is the first evidence of what that instrument change looks like in practice. The prior year's total exceeded before April. That timing is the message. Agencies do not accidentally triple their quarterly disbursement rate. The decision to front-load an entire year's worth of quantum spending into a single quarter carries a deliberate signal. The political cost of delay has been formally ranked above the cost of capital. When a plan document converts a technology designation from aspirational to mandatory, the implicit instruction to every state-directed investment vehicle is that moving slowly is now the riskier choice. The Q1 figure is therefore not a peak to be interpreted as an anomaly. It functions as a floor. It represents the minimum quarterly rate that the plan's language now requires, because falling below it would mean the imperative designation was not honored, and in the plan architecture, that is a different kind of failure than spending more than projected. The competitive reference frame around this reading sharpens the picture further. Through roughly 2024, the public benchmarks for quantum progress were programs running out of the United States. Large technology firms announcing processor milestone achievements, federal research agencies distributing grants across an ecosystem of universities and startups, and defense research programs funding longer horizon work. That investment structure is distributed by design. It spreads capital across corporate research budgets that are annual, board-approved and tied to product roadmaps with shareholder return expectations attached. The quarterly disbursement rate for any single firm in that ecosystem is constrained by what the board authorized in the prior planning cycle, and it moves on a corporate clock, not a plan horizon. State-directed capital does not have those constraints. It can concentrate in a single quarter in a way that no corporate research budget can match, because no shareholder vote is required and no product timeline governs the release. If the Q1 2026 quarterly rate were sustained across all 4 quarters of the year, the resulting annual figure would rank among the largest single-nation quantum investment totals reported anywhere. That comparison is not about qubit counts or error rates, where the technical measurements are more complex and less settled. It is about the capital side of the ledger, where the gap between state-directed consolidated deployment and distributed corporate plus federal spend is narrowing independently of where each program stands on hardware. The accelerant behind that narrowing is not only the 5-year plan, it is also what happened to classical compute. Advanced semiconductor manufacturing, logic nodes at the leading edge, high bandwidth memory, and the specialized accelerator hardware used for large-scale machine learning workloads, all of these became subject to tightening export controls beginning roughly in 2022. The controls targeted the most advanced process nodes and the tooling required to manufacture them, and they bit hard. Chinese firms and state programs that had previously invested simultaneously in both classical compute capacity and quantum research found that the classical path was narrowing. The option to acquire or build out leading-edge logic silicon through commercial channels was effectively closing above a certain threshold. Capital that had previously flowed toward that classical capacity did not disappear from the budget. It needed somewhere to go. Quantum computing sits almost entirely outside the supply chain constraints that govern advanced silicon. The physics is different, the manufacturing process is different, and the chokepoints that define the frontier in 3-nanometer logic fabrication are largely irrelevant to a superconducting qubit or a photonic processor. The Q1 2026 reading is partly a redirection map, capital that could not flow toward restricted silicon routing, instead toward the one frontier where the controls have not yet been drawn. This mechanism does not explain the entire magnitude of the delta. The 5-year plan designation would have accelerated quantum spending on its own, but the export control dynamic is a structural accelerant that the raw figures do not display. The restriction intended to hold a competitive advantage in classical compute created a surplus of capital with no classical destination, and that surplus found the open outlet. Block one outlet in a pressurized system, and the pressure rises at every other opening. Quantum was already the most strategically attractive opening. The blockage made it the most liquid one as well. The budget justification that ties both mechanisms together is a single capability. A sufficiently powerful quantum processor can break the public key encryption standards that underpin the majority of secure digital communications and financial infrastructure. Not a general-purpose quantum computer capable of running arbitrary workloads, but a cryptographically relevant one, sized and stabilized specifically to factor the large numbers that current encryption relies on. That single capability is what every serious national quantum program is racing toward or racing to defend against. The industrial imperative designation in the 15th 5-year plan is not primarily about quantum chemistry or materials simulation or optimization problems, though those applications exist. The language reflects an assessment that the timeline estimate for reaching the cryptographically relevant threshold has shortened, and that the cost of arriving second is not a competitive disadvantage in a market, but a structural vulnerability in national security and financial infrastructure simultaneously. The spending rate reflects that the timeline estimate moved. How much it moved and what that means for when either side might reach that threshold is a separate instrument not yet calibrated. 3 points constrain how far this reading should be pushed. The first is the distance between spending and capability. 3.2 billion yuan disbursed is not 3.2 billion yuan of working quantum hardware. Capital commitment and demonstrated qubit performance are different instruments entirely. Programs at this scale can spend aggressively on facilities construction, talent acquisition and retention, supply chain development, and manufacturing build-out without producing a peer-reviewed qubit milestone that advances the technical frontier. The spending reading is real. What it will eventually produce is a separate measurement that has not yet been taken. And history contains no shortage of large government technology investments that produced facilities rather than breakthroughs on the timelines the initial disbursement implied. The second constraint is the absence of independent verification. State-directed investment figures in China's quantum sector are not subject to the same third-party audit structures that govern publicly traded corporate research budgets. The Q1 figure comes from reported government and state-directed totals. Independent confirmation through international financial disclosures, academic grant databases, or arm's-length institutional analysis is sparse. The number may be fully accurate. It may also include capital that has been committed on paper but not yet physically deployed, or it may aggregate investment flows across multiple vehicles in a way that counts the same yuan more than once as it passes through different reporting entities. The instrument reads what it reads. The question of whether the reading instrument is itself calibrated to international audit standards is open. The third constraint is the physical frontier that capital cannot simply purchase its way past. Quantum computing faces engineering limits that do not respond linearly to investment. Coherence times, error rates, the thermal engineering required to operate systems at temperatures near absolute zero, and the challenge of scaling qubit counts while maintaining entanglement fidelity all impose timelines that are not straightforwardly shortened by budget size. The gap between a large quantum investment figure and a cryptographically relevant quantum processor is not primarily a budget gap. It is an engineering frontier where the path forward is not fully mapped, and deploying more capital toward a path that is not yet charted does not guarantee a proportionally shorter arrival time. The spending curve bends sharply upward. The technical curve does not necessarily follow the same slope. The instrument reads what it reads. 1 quarter, larger than 1 year. What that spending will yield and on what timeline is a different instrument not yet calibrated. The delta points one direction. A government designated a technology as an industrial imperative and then demonstrated in the first quarter of the plan's opening year that imperative tier designation produces imperative tier disbursement without lag. The restriction on advanced classical silicon did not freeze the overall technology budget. It rerouted capital toward the one frontier where the controls have not yet been drawn. And the Q1 reading is the first evidence of how much pressure had built behind that routing. The wall did not hold the number. It bent the curve toward quantum. 3 months read larger than 12, and the plan has 4 more years to run. The full year 2026 figure arrives in early 2027. The question that reading will answer is whether Q1's quarterly rate held across 3 more quarters, which would confirm that the imperative designation converted into a sustained annual deployment posture, or whether the curve peaked at the moment the valve opened and settled back into something closer to a prior year pace. That distinction matters. A sustained quarterly rate is a policy. A front-loaded surge that normalizes is a signal. The 2027 reading will tell us which instrument we were actually measuring. If you want to be there when that number lands, subscribe and turn on notifications. We will measure it the same way we measured this one.